Hello, everybody, and welcome to CI Live. Here we discuss the latest developments in global commodity markets. My name is Vladimir, team lead for the APAC crops team, and our work focuses on supply and demand research and forecasting. I'm joined by Aiman, our regional palm and vegetable oil specialist. Today, we are heading to Southeast Asia, the center of global palm oil production. Specifically, we will be discussing Indonesia's biodiesel program and its potential impacts on trade flows.
Right. This is a critical issue not just for the region, but also for food prices, renewable energy targets, and even, to a certain degree, geopolitical dynamics. So let's unpack what's going on and why it matters.
Let's start with Indonesia. In January 2025, Jakarta announced the implementation of its B40 mandate, requiring diesel to contain 40% palm oil, up from the previous 35%. Its main goals are to reduce fossil fuel imports, support palm farmers, and, to a certain degree, meet climate pledges. However, now it appears that this policy is hitting some turbulence, with the government recently giving producers and fuel retailers until the end of Feb to adapt to the B40 mix. Aiman, let me ask you, what's gone wrong?
So the main reason is a lack of funding. The program relies on a subsidy fund uh, fed by palm oil export levies. Although the region saw higher palm oil prices last year, the volume of Indonesia's exports had been declining. Back in November, the Indonesian Palm Oil Fund, or BPDPKS, warned that the fund will require around 47 trillion Indonesian rupiah for subsidies to allow for the implementation. Just to give you sort of what that looks like, forecasted revenue for 2025 is placed at 20 to 21 trillion rupiah.
Right. And all that is further compounded by issues around deforestation and sustainability. To meet B40, Indonesia needs 19 million tons of palm oil annually. That is 60% of its 2023 production. However, expanding plantations risks clearing more rainforest, which brings the EU's new deforestation rule into question.
Ah, yes, the EU Deforestation Regulation, or EUDR. Starting in December 30th, 2025, the EU will ban imports of palm oil as well as other commodities linked to deforestation after 2020. Companies must prove that their supply chains are clean, and both Indonesia and Malaysia are scrambling.
Without doubt, the regulatory requirements are stringent. Smallholders would find it difficult to comply as geolocation tech and services are not necessarily cheap. Considering smallholders represent around 1/4 of Malaysia's and around 2/5 or 40% of Indonesia's total plantation area, it seems Malaysian palm oil exports are better placed to benefit from this shift.
Yeah. Here's the kicker. The EU is the world's third largest palm oil buyer, and Malaysia's stockpiles are so tight that any further disruption will likely spike global prices. Which brings us to our next point. As of December 31st, Malaysia's palm oil inventories have fallen to 1.7 million tons. That's an 8-year low.
Let's elaborate on that. Previously here on CI Live, we discussed how palm oil production has been underperforming due to a suboptimal tree age profile and persistent weather disruptions.
Exactly, and output remains below pre-pandemic levels despite the return of foreign workers. The Malaysian government is also urging companies to fast-track automation, with SD Guthrie spending almost 100 million ringgit into the development of robots and machines to take over non-harvesting tasks. This is stuff like monitoring yields and pesticide application.
Yes, and all of that has led to an increasingly tight balance sheet for palm oil, with not much long-term structural improvement on the horizon. Now, that raises some flags for global food security given palm oil's role as the world's most used veg oil. And if Malaysia can't rebuild inventories, any supply shock has the potential to push palm and veg oil prices higher still.
Enter soybean oil. The USDA forecasts global soybean oil production to hit 65.9 million metric tons in 2024-25, up 4.9% year on year. Now, why is that? Ideal weather in Brazil, plus the US diverting more soybeans to crushing for the production of renewable diesel.
India's recent purchasing behavior is key here, with its Q4 2024 soybean oil imports almost doubling on a year-on-year basis. But there is a catch. Soybean oil's discount to palm oil cannot last indefinitely. We should expect US soybean oil to price itself out of export channels once inventories begin to tighten on the back of these higher exports and domestic use.
And let's not forget sustainability. Soybean farming drives deforestation as well, just as what we saw with Brazil's Cerrado. We should note that soybean imports are not exempt from EUDR regulations.
So, what are the key takeaways? Indonesia's B40 is a high-risk bet that could strain global palm oil supplies. Malaysia's stockpile crisis adds volatility, and the EUDR is forcing a sustainability reckoning. Soybean oil's rise shows how markets adapt, but not without trade-offs.
Yeah. Farmers in both countries are on edge, and one bad policy move or drought could ripple into higher palm oil prices with far-reaching implications, all the way down to higher manufactured food prices in the US and even the cost of cosmetic products in Europe. The veg oil market is a silent driver for inflation, and it is a very fragile one.
Ultimately, this is not just about palm oil, but presents us with a much more important question, that of balancing climate action and food security. So that is it for today's CI Live. I want to thank Aiman and you, the listener, for joining us. If you found this discussion insightful, please be sure to check out our other resources or get in touch for a conversation about our various in-depth research on palm oil as well as the other vegetable oils. Until next time.